There are obviously other ways that you can invest your money beyond just putting it into the savings account or a checking account in a bank. You can, for example, invest it into a number of other options. So financial institutions have many different types of options. And when I say a financial institution, it could be a bank, it could be an investment brokerage, it could even be an insurance company. But generally speaking, there's higher levels of risk associated with investing outside uh, of a savings account or a checking account. Now that being said, generally speaking, the greater the risk, the greater the potential reward. Um, but you also, you stand to potentially make some good money, but you also stand to potentially lose some good money. So it's important to know what these different types of investment options are. So one type of investment option that you've probably heard of, and that's certainly popular, is something known as a mutual fund. Mutual fund is basically a mutual means together, and so you and a whole bunch of other people invest your money into a certain fund. You basically create a large pot of money that you yourself wouldn't be able to create. And then as a group of 1,000, 10,000, 50,000, 100,000, whatever it is, people that have invested their money into this fund, people then manage it. So professionals, try and manage and work the stock market, the bond market, etc., in order to make as much money as possible, and then you get a share of that in the form of like buying a stock almost. So it's an investment where people combine their money together to buy both stocks, bonds, and other assets. Could be property or rental income and this type of thing. And usually it's managed by a company or a group of individuals, and then they charge a fee for their services. So, uh, you might make 8% in the fund, but there's a management fee of say 2%. So the company keeps 2% of all of the profits or all of the money that was made. Uh, and so your actual return would be closer to 6 or something like that. Okay. A GIC is a guaranteed income certificate. It's a very safe investment. It is literally guaranteed. It pays you a set amount. You know the day you invest your money, how much you're going to get from the bank or financial institution when you take it out. It typically will pay a little bit less in terms of it can make less money than, say, a mutual fund can potentially. And so you can't, the only challenge with a GIC is that you're not allowed to take your money out beforehand. So you can get GICs for 1 year, for 2, 3, 4, I think 5 years is the longest one that I've seen. You can also get really short-term GICs, 90 days, 6 months, that type of thing, but they're not nearly as common. And so GICs is another potential way to invest your money. An RRSP is a registered retirement savings plan, which I recommend that all of you start as soon as possible. An RRSP allows you to save money now in your younger working years that is not taxed, so that you can pull that money out later down the line when you do decide to retire, and then you pay tax on it when you retire as opposed to right now. Generally speaking, though, the idea is that when you are retired, you will make less money than you do when you're working, and so therefore you'd be dropped into a lower tax bracket, which makes an RRSP potentially a good tax investment for you. An RESP is something like an RRSP, except an RESP is specifically for education savings. So the cost of college and university continues to go up and up. And so the government allows parents and guardians and whatnot to invest money in an RESP for a specific individual for a certain amount of time, and they will actually contribute money to it. Okay, so for example, the government, I believe at this point, is willing to contribute 20% of the value of an RRSP up to a total of, I want to say $400 per year that they will put in. So it's not exactly free money, but they're helping you to save money for a child, for a niece, a nephew, a grandkid, or whatever. Okay, and its entire purpose is to save money for the future. So chances are that most of you over the course of your life will invest in either a GIC or mutual funds in some way, shape, or form. There are other forms of investment as well out there. You can invest in bonds. You can invest in actual commodities. Some of you may choose to buy individual stocks, um, but but whatever vehicle you choose to invest in, whichever way you choose to invest in, there's always certain benefits and risks associated with it. Okay, but by far in Canada, mutual funds and GICs are the most popular, and the investment things out there are usually the RRSP as well as the RESP. There is a third one that's out there called a TFSA, or a tax-free savings account, which allows you to invest money tax-free, and so you don't pay any tax on the money that is earned in that particular account. And those are things that you would want to discuss with your financial institution or your bank or whatnot to see what kind of options are out there. The idea is that the government wants you to save money so that you can have it for a rainy day down the road, or so that you can save up to make major purchases like a car, a big vacation, or for most people, they want to buy something like a house or pay for education or their retirement down the road.